With that, I want to warmly welcome everyone here today to the first webinar of our 3-webinar series. Today's webinar is financing for sustainable growth, so fully focused on the subject of financing. And we'll briefly introduce our team here and share with you some insights from the perspective of Aquila, as well as some of the players we work with. My name is Ali. I'm the Director of Growth at Aquila, and I'm joined here today by my colleagues Stefano, so our CEO, and Juvjen, our Lending Director. Thanks for being here, guys, and thank you everyone for being online and joining us today. So very briefly, we'll start with a quick poll. So we'll share with everyone the poll so that you can fill it in while we were doing our presentation. We will love to hear from everyone what their challenges are that they're facing in raising debt financing. Then we will go to the discussion. So we will share an overview about Aquila. We will share more about debt financing. So we'll have an expert, Juvjen, our Lending Director, sharing his knowledge about debt financing. And then we'll have a showcase, customer showcase. So our customer, Okapi, will be sharing some insights as well. Then we will share the results of the poll and also do some Q&A. So feel free already throughout the webinar to start sharing your questions in the in-call messages. So if you go to the bottom right of the screen, there is a little chat symbol. If you click there, you'll be able to send a message. You can place your questions there. We will answer them at the end of the session, or if they're relevant in the moment, we can already answer them when you ask them. So yeah, please start populating that. With that, I would like to give the floor to Stefano. In the meantime, I will share in the comments the link to the poll where you can fill in your answers. So with that, yeah, I would like to hand over to Stefano to give an introduction about Aquila and share a bit about how we do the financing.
Excellent. Can you hear me well?
Let's take it as a yes.
Okay. So Aquila is a climate tech company in a nutshell that provides working capital to companies in the sustainability space in Southeast Asia. The way we do that is that we have a data arm that receives data from our customers, companies in the renewable energy space, solar rooftop, electric vehicles, electric bikes, e-mobility, agritech. We receive the data on the impact of these companies in terms of CO2 reductions, emissions, energy savings, water usage. And we use this data to help these companies, our customers, unlock the working capital that they need. This is it about Aquila, I would say. I will tell you how we started with this concept, and I started working on it also in my previous company, and now Aquila is bringing this to fruition, which was to help asset-heavy companies. I started from the renewable energy space that needed working capital to finance their growth. I think that I have a couple of, it's one slide that I want to show to explain how this all started, and it will take me 3 minutes literally. The first time we identified the need for asset-heavy company in the climate space to receive working capital was for me many years ago. My background was that of lawyer in the project finance space. So I've done financing. I was working with international banks and financing large projects in the renewable energy space, 100 million, 200 million per project. I did many of those. And so I knew how these companies needed financing and how were they collecting from banks, but large amounts. And I identified that the companies that are on the smaller end of the spectrum that need to raise 1 million, 2 million, 5 million, they are often too small for banks to assist them. And that's why also in my previous company, we started financing these companies. We realized that these companies had assets because they had already developed projects. Maybe they had already, I started with the solar rooftops, right? They had already developed, for example, 1 or 2 megawatts worth of solar rooftop projects. But the same concept also applies to, electric vehicles, battery storage, solar pumps. So they had assets, and you see them here, right? They had a couple of assets that they had developed. They had put their investment money into these assets. So all their cash flow was into these assets. They were built operational. They were generating cash flow. So every month, the factories on whose rooftop they had installed the solar panels were paying their money. So they had receivables every month. But it would have taken them a few years to receive enough capital back in the form of these monthly payments in order to have sufficient capital to build more power plants. And so what we did, we said, well, but we know the space. We can see that these power plants are actually good. They're installed well. They have all the permits. They are compliant. They're good assets. So let's do this. We will take these 2 assets that you have already built as a security, and we will provide you working capital to build the next batch of assets. Can you click on the slide, Ollie? 1 second. So we take the assets that are already built, and we give you the financing to build the next power plants. Within 6 months, the company had built additional 2 power plants. And this started a positive cycle, because at that point we could say, look, you have built 4 power plants. We can make sure that the quality of these power plants is good, that you have good off-takers, that you're getting monthly payments from all 4. Fantastic. Let us now take 4 power plants as a security. If you can click, yes. And now we will give you $2 or $3 million to build the next 4 power plants. And once these 4 are built, then we can give you money to build the next 8 power plants. And this allowed our early customers, 7, 8 years ago, to build quickly large portfolio of assets. And this allowed them to do 2 things. Either they had sufficient amount of assets to be bought out as a company by larger players in the electricity space. For example, one of our customers, through our system, built another 7, 8 megawatts. And at that point, they had a portfolio large enough to be bought by a big energy conglomerate in Malaysia, right? That was a great success story. Others instead had a sufficiently large pool of assets that now their need of capital was $10, $20, $50 million. And so they were able to now work with banks or larger private debt funds that would have never considered them for $1 million, $2 million loan, but they were very happy to support for 10, 20 million. And so they managed to unlock larger pools of capital at lower interest rate and continue on their journey. But basically, what we did with our financing was to help them to go from 0 to 1. And once they got to 1, like enough assets, they were able to continue their journey with larger, more institutional players. And that's where our mission ended, right? So we were there to provide working capital in those early stages when no one else wanted to finance these companies. So this is how Aquila was born. This is what we are doing today. Thank you for listening to this short presentation.
Thank you, Stefano. Yeah, anyone who has any questions, please start sharing them. And before we hand over to Juvjen, I just want to share that I placed a link in the in-call messages. So if you click that, you should be able to go to the poll where you can fill in the types of challenges that you're facing with debt financing. So with that, I'd like to hand over to Juvjen. I'll go to the next slide here.
All right. Thank you, Ollie. I think first things first, just to mention that this is to give a bit of a general context, so you guys have a kind of a starting point. Of course, when it comes to financing, at every sector of it, equity, debt, grants, everybody has their own strategy. The market is very broad. So this is, take it with a pinch of salt as a general guideline. Of course, you'll find many players that deviate from this. So this is not really an install, it's just for people to get an initial sense to get them started when they look for financing, right? So let's start from the more early stage, the seed stage. Mainly in sustainability, this comes from grants, usually government-backed grants. The main idea is that the company doesn't have a product market fit. Actually, most of the times they don't even have a proven technology. It's kind of almost in R&D phase, and they have little, basically no revenue and almost also no customers. And many times, what is the outcome that these grants are for is essentially mostly they look at the impact that this investment might have, and it's not necessarily a financial ROI. And also is some sort of branding reputation for the government that grant this money, so they're kind of known essentially to be in the space to attract talent and so on. Then you have a bit the equity stage. This is a more early stage in the sense that the company already has a product. It's kind of functioning, but normally they are at a very early stage with a very few customers with volatile cash flows, and sometimes they're also in the middle of a business pivot because they have started something. They realized that they could attract the first 1 or 2 customers, but it was very hard for them to scale to 10, 20, right? Here, the investors hope and their expectation is that with this equity, there will be some sort of exponential revenue growth that comes also with some sort of consistency. Then, when the company has reached essentially a more stable revenue stream, and they plan to leverage on that, which links a bit to the example that Stefan was mentioning, that they have the 2 power plants first, and then they want to expand and use what they built so far without sharing the ownership, then they usually look for debt. And of course, when it comes to debt, the investors are a little bit more precise on what they expect, and they expect a timely repayment, certain payback amount, everything is more rigid, more settled before the agreement, of course, which is of course easy to execute when you have a stable revenue. I think we can move to the next slide. Thank you. Okay, so again, we have done here it's millions of ways, some way to dissect and basically to do profile loans. We have just chosen 2 out of the many, which we believe reflect a little bit better when it comes to sustainability financing, right? So the first way to dissect it is essentially secured and unsecured loan. Just to give context of the secured loan means is that there is an asset that is dedicated to that loan. So in case there is a problem of repayment, the loan has a bit of a, let's say, fallback recovery plan, right? So in sustainability, of course, most of the times this asset is like a physical heavy asset in some sense, because that's fundamentally the how the business is structured itself. And of course, these loans are used for more long-term investments, which is usually from heavier assets. If you think about it, for example, you'll see in general in all across markets that, for example, receivables are an asset that gets collateralized at times, but usually they are 3 to 6 months, right? Of course, many times the amount needed in debt financing is longer because they are for heavy investments, and so that's why this is the most common type of asset that gets securitized. One common thing, of course, if you're looking for debt financing in the sustainability space, and of course at a good rate, is that this asset that you want to collateralize needs to generate predictable cash flows, right? Because that's what gives a lot of value to the asset, both in terms of not forcing the lender to have to liquidate it quickly because it's already generating asset cash, and also it gives it value in the market. Obvious to say that if there's an asset to back up the loan, generally the risk premium gets lower because of course there's a fallback if it doesn't work out. The unsecured loans, as you can imagine, there's no security linked directly to the loan. To speak from a very practical point of view, most of the times this will be quite expensive, and I would say that most of the times the reason players in sustainability, especially if it's a startup, will take them is so they can show some sort of what is called repayment discipline. So the next player that comes to try to give them a loan has seen that these guys actually know how to deal with a loan. Sounds obvious, but there are a lot of customers that are inexperienced with that, and big lenders that don't want to really deal with someone that has never received a loan before. They can ask you many things to give you unsecured loans. It's not uncommon to ask some sort of personal guarantee from the CEO because, of course, they want to make sure that you are fully aligned in repaying that loan. But again, this also varies a lot. The other way is essentially cross-border versus local loans. I think dimension to see it is that the more niche is the more niche your sustainability business is, the higher the chances that the cross-border player will fit your profile, because usually the local market is too small for your business, and the international player has seen it across countries and has specialized in it, and would normally try to give you at least a bigger amount because they would have more confidence in your business as they've seen it across the board, right? And normally international players try to be quite standard and quite transparent because, of course, they have to deal with different markets. Now, that doesn't mean you cannot get a loan from a local player. Many times you do, but you have to be aware that normally it has to be quite popular as a business in that market, so they need to be familiar with it. And of course, most local players have kind of a standard SOP. If you deviate too much from it, it might get quite challenging to get the money or to get them at a good rate as well. I think we can move to next. So again, talking a bit about the process, everybody has their own in some sense. So this is just a broad generalization, what roughly you could expect, right? So the typical documents everybody will ask is that they'll need some sort of general understanding of the company info. Usually they'll ask you for a presentation, or sometimes they have their own forms, like you fill in this and that so they get a sense. They'll need your bank statements. It goes from 3, 6, some go 12 months, depending. Bank statements obviously are quite critical because it's, let's say, a third-party source of information, which they can kind of fact-check everything else you say as much as possible. And they need some sort of financials. Normally, the younger is the company, the more they will need management accounts, which are not more than 6, ideally 3 months old, because of course the life of startup is very fast-paced, and your audited financials from 1 year ago, things could have changed drastically. Normally, I would also ask you audited financials just to kind of back up whatever you share on the management accounts, that kind of, at least have some sort of financial that has been reviewed by somebody else, right? Some players do an interview process, which in some sense is not like a job interview, it's more to put things into context based on the numbers that you have shared. As you can imagine, sitting in a room and just looking at data sometimes might be quite tricky, and then having the person that made this data, which is usually founders or the finance team of the borrower, use a lot of context that makes it much more easy to get a good sense of the company. And then if things go through, then basically starts a bit the borrower's negotiating side, where you at least you have a high level alignment on the term sheet. Normally there is a site visit. The site visit can happen anytime, actually. It can even happen during the process for you to get convinced to as a lender to give a loan. But sometimes it happens at the end just to validate. So this one we could potentially expect it anytime in some sense. And yeah, the final part, of course, the agreement. And I think in the next slide, we'll touch base a bit on what to look at before you sign the agreement, which is at the end of the day the most important part as a borrower. These are, of course, some common things that we have noticed with the players we work with. The first part is, especially when you compare players, if you just look sometimes simply at the price, it's a 10 to 50% interest at whatever processing fee. Well, if one lender asks for warrants, then, well, he's also sharing the upside, and that's a quite important factor. So that is one very important thing to know, because then if you're comparing a lender that asks for warrants and one that doesn't, basically one that asks for some sort of equity and a discount and someone that one that doesn't, it's a very different product. So you have to look comparing apples to apples anymore.
This is the venture debt, right?
Yes.
Companies that want equity.
Yes, correct. But in agreement, they wouldn't write venture debt. It's still a loan agreement, so you need to figure out yourself that it's a venture debt.
Right.
The other part is a bit the covenants. So I'm sure all you guys check, but of course you need to be very aware of the covenants, because you you think you have 5 million, you maybe don't read them carefully, but you realize that together you get the initial 2 million, let's say, and then together remaining 3, you really need to be going to the moon, and you might not get it. So it's quite an important discussion point to give you a peace of mind in the future when time comes to get the other tranches. Or sometimes it's not even about the other tranches, it's like how you repay. If you break the covenant, you might have to repay it. Sometimes it might mean the end of your business. So obviously need to be careful. Legal costs, again, this one is among the more murky ones, and it's also fair to say that there are legal costs, and sometimes you need to have them. But the key idea is that try to get also a bit of a general, let's say, rule of thumb, how much roughly should cost, so you get a sense of what the lender will do. Because it's one thing if they tell you some legal costs, which are usually a couple $100 to notarize, legalize some sort of stuff. And one thing is that they tell you, well, I've gotten the best law firm in the country, and we need to make an agreement from scratch that will cost you the thousands of dollars, maybe the tens of thousands. So as you can imagine, that really has pretty significant impact on the overall cost of the loan. Late fees, this sounds obvious, but I think surprising a lot of people neglect it, and we have seen quite a few businesses which, you know, they were in between fundraising, they didn't pay, and now they're disputing with the lender, sometimes even 50% of the principal that they had to pay because they were late 3 months, 0.2% a day, you know, it escalates fast essentially. So this one, hopefully you'll never need to implement it, but sometimes, you know, you don't look at it, it happens, and then when you get your next fundraising, a big chunk of it is gone because you have to pay the late fees because you've signed for it. The other part is the kind of interest calculation. Again, to be fair, this one is usually on the smaller amounts, but always be careful in the sense that normally you should pay interest only on, and this is more applicable when you do amortizing loan. Normally you should pay the interest as a portion of the outstanding principal, which means that if you have been paying a bit of the principal, a bit of the loan every time, then your interest should gradually decrease. But there are some players in the market who just do some simple math where they say, okay, I give you 100 for a year, for 1 year, 20%, 120 you have to pay me, and every month you pay, you still pay 20%, and that adds up in a real interest of sometimes 30%. So check basically the advice is check the repayment schedule, just make sure that you know what you're doing. This has some generic advice from things that we experience every day, so it's also good to share with you as well. I think this should be the last slide.
Yeah, thank you, Juvjen.
Thank you.
Really insightful. So just want to give everyone a last chance to share with us the challenge they face in debt financing. So if you go to mentimeter.com and fill in this session code 26826283, or you go to the messages, in-call messages here in the bottom right, you can find the little message bubble. You can go to the link and you can fill in your answers here. We'll let it run a bit longer, and then we'll share the results with everyone. And now, as a next step, I would like to share the showcase of Okapi and Aquila. So let me open that up. Unfortunately, Juvjen, the CEO of Okapi, couldn't join us here today. So he has helped us to pre-record an interview, which we're very excited to share with you all here. So hopefully this works, and if there's any challenges, please raise your hand or share in the comments.
Hi, Juvjen.
Hi, Oli. Hey, how are you doing?
Good to see you. We are having this session today on financing for sustainable growth, and we're really excited to have you as a close partner in the business as we both grow. We've been really impressed with your knowledge on financing, I know it's a big part of your business, financing, so you must be. You're scaling fast. You're doing this in an asset-heavy space, which is not so straightforward. Yeah, would love to ask you a few questions. So maybe starting with, what is the problem you're trying to solve for solar in Malaysia?
Thanks, Ollie. I think the simple answer is that we're trying to solve for what should be a very cheap source of power for most households in Malaysia, which unfortunately they are unable to access due to the high upfront costs, right? So the way we structure our financing is to bring down the initial barrier to entry in terms of the upfront costs. We structure it into affordable monthly payment plans that they can pay over a long period of time, in our case up to 10 years. So a lot more friendly from a cash flow perspective. And then we figure out how to really structure the financing, right? Rather than leverage Joe's who just want cheaper power.
Thank you. Very clear. So at the beginning, when you just started your business, I know you first relied more on equity funding. Why did you do that?
I think it's obviously for our business, which is asset heavy and the financing business, eventually we want to be almost entirely financed by debt. And these are the assets that we are financing, right? And then make money off the differences between the cost of debt and what we're charging our customers. But to begin with, I think it's difficult to get debt financiers who are typically more risk averse, more concerned around loss minimization, finance a brand new business. So you have to go down the equity route, right? Go to equity investors who are kind of comfortable with the idea that most businesses don't turn out that well, but then they have a different strategy around how to manage that, right? So I don't think it's a choice per se, more that that's how you're gonna get something off the ground. Really doing some money yourself as well, just to put money where your mouth is, and from there, build traction, show initial proof of concept, show that you know what you're doing and people are paying you back. The business model is viable, and that's what the investors want to see over a period of time.
Yeah, very right. So when and why did you decide to look for debt capital, and maybe how?
From day one, this needs to be financed primarily by debt. I imagine if we have like $100 million or $200 million worth of solar panels around the region, if we finance it through equity, we'll be diluted in our own business to like 0.01% of the company, right? So this high quality assets which generate pretty predictable stream of income. So that's what the investors want. They don't need a stake of the business. They just need the cash flows of the underlying asset. So it's a non-dilutive way to finance the growth of the business, right? So it's a very natural kind of financing structure for us to think about if we can get access to it, which is why we use equity first to get access to that, right? Now, how do we go around getting that? I don't think there is a formula per se. It's very similar to equity fundraising for startups. Referrals are always highly preferred, failing which or top of which you can always come to events or ask for introductions, and all the way down to the bottom of the list is really just cold emails, cold outreach, which is you gotta do anyway, just on the off chance that someone responds, right? So similar to equity fundraising, you just need someone to say yes, right? 1 out of 100 people you reach out to say yes, and you can grow the business. So I think it's more about grit and not trying to take the shortcuts, right? Just basically just do what you need to do to increase the chances of finding someone to say yes.
And I guess solar panels are great, like you said, they're cash generating assets. How do lenders typically view them as collateral, and specifically in Malaysia?
So it's quite a new asset class, especially for residential solar. So solar assets in general, it's not new, right? They have project finance that have like enabled the construction of huge solar farms in the region for the past 30 years, right? Just like any other power plant projects. But at the residential level, it's still very new. So typical commercial banks or other kind of incumbent lenders aren't exactly sure how to assess the reliability of this collateral, right? Are you financing against asset itself, or you're financing against a consumer kind of credit. So it's kind of like a gray area, but you know how these banks are, it's kind of, if it doesn't fit in a nice category, then they don't do it, right? Which is why we kind of found Aquila's approach pretty interesting, like pretty encouraging as well, and we do appreciate the support because we look at things from a first principles basis, right, rather than some kind of inherited framework of financing legacy assets. And look, these assets are with homeowners with high credit scores, who are saving money through Okapi rather than paying the power bills, which is a necessary expense, right? It's not a discretionary expense. You need power to survive in a society. So just, do you think this is something that people will continue paying as long as they're living there?
You mentioned Aquila here, and we really wanted to get a borrower on the webinar here today. So what is your experience with Aquila so far? What are you happy with? What are you unhappy with? Yeah, be brutally honest.
How brutal. I'm kidding. Well, no, I think generally it's been great, right? I think, look, we wouldn't be able to scale as quickly as we have if it weren't for Aquila being there when we had to raise financing, right? For business like ours, it's always a balancing act. Do we grow fast and expect the funding to be there when we need it? Or do we like put everything nicely and get the best structured financing before we grow? And I think at an early stage, the answer is always the former. You can't expect people to give you the money first in the structure you want, the perfect structure before you do anything. You just gotta bite the bullet and go ahead, right? With whatever you have available. And I think the speed that Aquila was able to be comfortable with our business model, with the data that we had at that point in time, I think it was almost a year ago when we first worked together. It was like 2 weeks, right? We basically signed agreements already, and then within like 3 weeks, the funds were in the account, and we didn't have to stop on our initiatives. So that was super helpful and super impressive.
Thank you. I really appreciate the feedback. So in terms of equity and debt, we touched upon it a bit before. What is kind of the split between the two, and how does that change as the business evolves in terms of percentage of equity invested versus percentage of debt?
Yeah, so well, it's something that we're also trying to figure out. Right? I think over the long term, our aim is to get to like 100% debt, at least on the assets side of things. Achievable or not, let's see. It's a goal. I think 80 to 90% debt is definitely achievable. Looking at how other project finance structures or precedents are in the region, right? Solar farm versus 100,000 houses that on paper looks like one big solar farm. I think it's the same project financiers that will actually come to the picture. So the question that we're trying to solve for is how do we get to that scale, get to that stage where the risk is against the asset class, not against the individual. It's because we have 100,000 uncorrelated borrowers that the individual risk is eliminated, right? So right now we're at about, I believe, 50% equity and debt. And in the beginning, it was like 100% equity, like we discussed earlier.
Thanks for that. And how do you view the lender landscape? Banks, funds, high net worth individuals, family offices, maybe others. And when is what type of lender a fit?
That is still difficult to access for early stage companies, whether you're asset light, asset heavy. In Southeast Asia, at least, it's difficult to find people who are willing to take this kind of risk at an early stage. People generally are not so comfortable extending long-term financing, typically 3 months, 6 months, 1 year, financing a PNPL or supply chain invoice, kind of having a 3 month amount time for it, rather than what we're doing now, which is like a 10-year asset. So that's actually our primary struggle is basically having to finance 10-year assets with 1-2 year financing. So there's always a refinancing risk involved. You know, wait for the perfect structure, be waiting until someone else has done the business and taken 90% market share already. Right?
And what are the advantages and disadvantages you've seen between local financing in the local currency, let's say Malaysian ringgit, versus cross-border financing in Euro or USD? And how do you manage the currency risk?
If I had my choice, I would always raise local currency. 2 reasons, right? One is obvious, there's no currency risk. Secondly, in Malaysia, the interest rate environment is actually quite low. It's cheaper than dollar financing. But unfortunately, Malaysia is even more conservative, and the landscape is dominated by traditional lenders like commercial banks. So we have to raise funding for overseas investors in dollar or euro terms. And I think the idea here is similar to why we are taking on other so-called imperfect aspects of financing, like shorter duration, higher interest, currency risk is another one of those imperfections.
Very clear. Thank you, Juvjen, for this. I really appreciate your time and for sharing your knowledge with the community. So hope to see you again soon.
Thanks, Ollie. Great.
All right. So would love to share with everyone the word cloud here, the result of the poll. So we see that these are some of the different challenges that people here in the webinar are facing. So underperforming assets, requirements, I guess challenges with meeting requirements, front market risk. What could that be? Okay. Well, we'll have to ask the audience to raise a hand. Or frontier market risk. I see. So the challenge of, thank you, Jess. So the challenge of getting debt for newer or faster and earlier how do you say that, less developed economies
And emerging markets.
and emerging markets, low equity. So I guess not having enough equity capital to get the right equity to debt ratio to meet the requirements. Asset data, so data about their assets. Well, definitely something we can support with. Interest rate, of course, that's the main part of the commercial term. As Jörn mentioned, the interest rate needs to make sense for your business model, for your internal rate of return. You need to have, of course, a margin between what you pay as an interest rate and what you can charge your customers. Energy efficiency projects, we have looked into this quite a lot as well, and definitely understand the challenges of financing energy efficiency projects, and currency controls. So
Sometimes hard to move money between countries.
very fair. So yeah, with that, would love to open the floor to the Q&A. So let me just go to the next slide here. Apologies for that. So yeah, we're very open to hearing from the audience here if they have any questions. So please write them in the chat box, or if you want, you can unmute yourself and share your questions with us. Any questions? We've received some questions from the attendees before the call as well. So one first question, and open to having this answered by Juvjen or Stefano. How does it work for Thailand?
You want me to go?
Sure.
Wow. Okay. I think there's no from that.
Maybe answer the one on Thailand, and then we'll move to Ralph. Thank you, Ralph, for raising your hand.
Yeah, I think Thailand is a little bit more of a tricky market in the way it's regulated. Now we cannot disclose all our secret sauces, that's how we run the business, but yeah, we have a bit of a way to essentially collateralize in Thailand. This involves also an assurance from the borrower that the pledged assets will not be disposed of without us knowing. But yeah, we have done also previously asset-backed loans in Thailand as a cross-border lend.
Anything you want to add, Stefano?
No, thank you.
All right, then I guess next was Ralph. You can unmute yourself and go ahead.
I think you wrote the question.
No,
sorry.
Go ahead, Ralph.
Okay, wait, I'm trying to turn off my my background here, because I actually have a cool background. I'm at my indoor farm.
Oh,
So pretty cool. There you go. Oh, there you go. Hey guys. So I'm Ralph Becker. I'm based here in the Philippines. I'm originally from Luxembourg, and I have a indoor farm company here, and we're here at the indoor farm, and we've just recently started the first preliminary talks with Ollie and the team, and basically we're very new to this, and we're currently raising funds, and I think I've been talking to Ollie and the team about this. What I think one of the parts we haven't gone through yet. What are the modalities of the different loans and the debt? Sorry, I'm a bit late to the party here. I had a couple of deliveries, but if you can just in principle on this, because we're still very much interested to further this conversation. Just the key pillars of that, like the loan terms and yeah.
Yeah, I'm thinking, do we want to show again the slides that I showed initially about?
And I apologize, I'm late to the party.
no worries at all.
But as I explained this again, I think it's good to visualize that.
Sure.
The main thing is that, as you can imagine, companies that are nascent and they don't have a long corporate history, right, and are relatively early stage. Obviously, I don't know the specific. Maybe you have a huge operation with thousands of employees, right? I don't know that. But often, younger companies struggle to receive financing from banks because they consider them too small, therefore too risky, too shaky. Aquila's approach is to understand that there can be valuable assets of this company and take those assets as a collateral. Right? We do that routinely with solar rooftop power plants. We do that with electric bikes. We do that with batteries, with solar pumps. It's a bit of it's not a one case fits all. But the two things that we check is that the assets are there, solid, and generate cash flow, right? That could be, for example, the solar farm, right, in itself and its operations. How do we operate that? We consider, once we can consider these assets as solid enough, and again, here we are much more flexible than, let's say, a traditional commercial bank. And therefore, we don't need to request for a crazy security, like, the house of the owner or a personal guarantee or stuff like that, right? It can be confined to valuable assets that you have. Then once that is clear, we take collateral over those assets, and we can finance you so that you can build more assets, right? For example, I was saying we started with the solar renewable energy companies. We took a few plants that had already built. We took them as a collateral when banks were not interested because the amount was too small. It was just $1 million, so banks didn't even want to look at that. And we gave them money to build the next 2 plants. And when these 2 additional plants were built 6 months later, we had the ability to take over collateral also those additional 2 plants. And so we took collateral over 4 plants, and we provided financing. You can show that only in the slides. We provided financing to build the next 4 plants. And this accelerates, and then once these 4 plants are built, then you can take us security over 8 plants. This has an acceleration effect over the asset portfolio of our borrower that then quickly allows the borrower to scale its asset-heavy hardware component and have that to reach the size quickly, whereby finally a local bank will be saying, okay, I can take 10 megawatts, for example, as security. So now I can grant you a loan from a commercial bank at a lower rate. And there, Aquila has exhausted its function, right? So we have from the 0 to 1 portion, and then customers are are sizable enough to walk with their own legs and get financing from traditional players. I hope that replied to your question, Ralph.
And then that's fantastic. And then later with that, once the company is able to raise funds with a bank on good interest rates terms, that's when you come in and then get your funds back plus interest rate.
And we get repaid and we get out of the picture. We are happy that we often help our customers to find additional sources of funding cheaper, because it means that they've become solid enough, and so they can keep their journey without us. They don't need us any longer, and therefore we help transition, right? Meaning that we have our loans refinanced, we cancel the securities that we have to make room for the bank to come in, take security, and continue the journey with our customer.
Fantastic.
Was there any other part of your question, Ralph, that was still unanswered?
Just a small part, like what is, if there's a compounded, like an interest rate on top of that? Obviously, it's not, you take, you have collateral, but that's as a security, but over time, and what is the time frame that you normally operate in? Like, is it over several years? Is it several months, or is there a minimal time frame?
We go from as short as 12 months to as long as 6-7 years. It really depends on the cash flow that your assets generate, and so basically what you need, right? If then you get a loan that is longer than what you need, let's say that you have a 6-year loan, but then you find financing after 3 years from a local bank, we take a step out so that you can continue with the local bank.
And I think in terms of interest rate, it really depends on your case, and it's not standardized across the board. So
Okay.
we would have to evaluate.
Okay, fantastic. Thank you so much. Thank you, Stefano.
Thank you as well for the question. But of course, the interest rates, we are working to make them fit within your business case, as we mentioned in the earlier slides, right? So that's always has to work. But thank you, Ralph. I see another question from the audience here, from Jess. Could you talk about the types of lenders that you see having the most appetite for renewable projects? For example, commercial banks, MDBs, private credit, etc.
I can take it. Just it really depends on the size, right? When renewable energy projects can encompass from the solar rooftop over a household, a few kilowatts, to the solar rooftop over a factory, 1 megawatt, to a solar farm that can be 100, 200. I work on solar farms that are 400 megawatts, so gigantic projects. And the size of the project determines who are the financiers that are interested. If you're looking at a solar farm, that's a project that needs financing north of $100 million, $200 million. Not even every bank will do that. There are international banks, Standard Chartered, HSBC, Citibank, you name it, right? The usual suspects. In Southeast Asia, also very active are the Japanese and the Korean banks, Sumitomo Mitsui, SMBC, and UFG, and so on. They are the kind of financiers for these gigantic projects. The downside is that they normally tend to not look at projects that are smaller, right? $50 million or $30 million or below. Local banks bridge a bit that gap, but also local banks rarely, and this varies a lot from country to country. Local banks rarely would consider projects that are, below $5 million. There are exceptions. For example, recently in Vietnam, we have local banks that are doing also smaller projects, but that varies. Private debt funds also are active. It depends really on the fund and the mandate that they have. Those that we are working with, we see that in any case, they are reluctant to write checks that are less than $5 million. And so there is still a gap between companies that are at zero, still at the beginning of their journey. And so, of course, they would want $5 million, but they cannot absorb it. They will not be able to spend $5 million in a few months and buy assets and grow that fast. it needs to be paced, right? The first check that they need is maybe 500,000. And there we see almost no private debt funds to write such a small check. There is a last player, which you haven't mentioned, which are family offices. Now, if you are lucky enough to have a strong relationship with a family office, they may be available to write a small check, like give a small loan for, let's say, $500,000, but they need to know you well. And also often they want to have higher returns. So sometimes they may try to have warrants, like as Juvjen was saying. I will give you $500,000 in a loan, but I want some equity. I want some shares of your company. So often the structures that they come up with are dilutive, right? So I would say this is a bit the spectrum that we see so far. I hope that responds to the question, but feel free to unmute yourself.
Yeah, thank you so much. That was really helpful. Thanks, Stefano.
Excellent. Thank you, Judge, for the question.
Next, I see a question from MD Arif Udin. May I know something about concessional financing for a biochar project in Bangladesh? I think that's quite a tricky one. I don't know if you guys want to jump in.
I would say that so we're open to it. Facts on the ground. It's not that we have done anything in Bangladesh, and we have to do a lot of assessment about it, especially given it's a new market for us. And yeah, it's not a closed deal, but like we can't tell you yes or no, right? It's a case by case, but we're of course open to evaluate.
I think also on the concessional financing front, it's probably best to look at different sources. So there's large financiers, like one that's very well known in Singapore and Southeast Asia is Temasek. They do a lot in concessional capital. So I would recommend looking there first. But feel free to send us an email or reach out to us in any other channel, on LinkedIn or so, and I will try to help you get in contact with the right people. Thanks for the question. And I see a comment from Krishnan from KK here. Would love to continue the dialogue further. So let's schedule a meeting next week for sure. Is there anyone else that wants to unmute themselves and ask a question?
Or type it.
Or type it, also okay. If not, I think we have one last question for Juvjen here.
Yes.
How does it work with energy efficiency?
Okay. I think for energy efficiency, what is a bit of a key factor, without diving too much into details, but is essentially how pre-agreed are the terms. What that means is that if you have an agreement with somebody that is using your energy efficiency equipment, that they have to pay you X amount per month, pre-agreed, the number doesn't go up or down contractually, that's definitely something that we are interested in. If it's more of estimation, calculate on savings and stuff like this, then we'll definitely need to go through the details, because of course, as you can imagine, a loan has fixed payments, so it needs fixed cash to feed itself after it's issued. So the more that part of the money and the revenue from energy efficiency is unpredictable, the harder it is to gain comfort to issue a loan.
Okay.
That will, I would say, this answer.
Thank you,
Ribbon baru 270 je bang.
Hello?
Astagfirullahaladzim.
I think
Thank you.
accidental unmuting of the mic here. I think it's maybe to add on for the energy efficiency. The assets used in energy efficiency can deviate quite a lot. So they can go anywhere from chillers and boilers, which are more expensive types of equipment, which are much easier to take as a collateral, to, let's say, sensors that measure energy consumption that are maybe more difficult to take as a collateral. But for us, just like with the solar panels, it's the strongest when the assets and the receivables are taken as a collateral jointly. So it's a cash generating asset that, sort of guarantees the return that pays off the debt, right? So the more certain, the better. So if there's anyone else, last chance for a final question. Okay, then happy to wrap up here. Thank you everyone for your time today and for joining in, and for all those that are watching later. Thanks for watching this webinar. Please stay alert for upcoming series. So we have one session next Friday. It's our second session, which is called From Impact to Revenue. It's about how to earn revenue from carbon credits. So many asset-heavy sustainability companies are able to earn carbon credits. So please join. And then in 2 weeks, so the Friday after, we'll have a session about proving and showcasing your ESG impact. This one will be about how to verify and visualize your ESG impact data, which is very important for fundraising, getting access to clients, and for things like carbon credits as well. So please stay tuned and join us for the next series. And with that, thank you and see you soon.
Thank you.
Thank you, everyone.
Bye, everyone.
Yeah.
And thanks for all the love.